Hi everyone, my name is Michael Glass for SCM Forex, and once again we're back talking about how to be a successful trader. As always, we like to start off with our disclaimers, and it basically slows down to any decision you make is your own. Any type of investing has a risk of loss. You can lose money. So the strategies and the concepts we cover are for educational purposes. Trade at your own risk. So again, this is our video series on how to be a successful trader. We're trying to show you how successful traders look at the market, how they frame the market in order to increase their odds and be successful. It doesn't mean they win every time, but it does mean that they increase their odds to be high probability traders, to be consistent and put the odds in their favor. To do that, we have 5 videos. We talked about, do you know what time it is? In that video, we talked about understanding the time of day and the type of day to be a successful trader. In the last video, we talked about chart patterns and how we can use those in conjunction with the time of day. Today, we're talking about technical indicators, technically speaking. We're also going to talk about stop and risk management and the psychology trading. And these last two, stop in the name of money, mental fitness, risk management, psychology trading, are so overlooked. So I really hope you take time to look at those videos. If you haven't watched the ones, please go back and take a look so that you can get caught up to where we are. But again, today we're talking about technical indicators. And, I'll be honest, I was one of those new traders at one point in time, and I went out to Google and found all these indicators, and I had indicator after indicator on my chart. Started to look like spaghetti. But I will say that the best thing is to keep it simple, find one or two that you like, and then move on. But in order to talk about technical analysis, I do want to briefly go over the debate of fundamental versus technical analysis. When you're looking at the fundamentals of a currency pair, or fundamentals of an investment vehicle, you're focusing on the data. You're focusing on the reports, the releases, the announcements. And you're forward looking. If you believe that the data is good, you believe that that currency pair is going to move up. You're focused on the what. Whereas technical analysis is looking at the past behavior, and you don't care about the data. You believe that because this happened in the past, it will happen again in the future. History repeats itself. So you're looking at what happened in the back, and you're hoping that what happens in the back will tell you when something new is going to happen. Again, it's your choice on what type of trade you're going to be, but since this video is about technical analysis, we're going to focus on that. So, what are some of the advantages of technical indicators? Well, first you have to understand that they basically are mathematical calculations on price action. Again, the past. And they're usually plotted to show you where price may be going. They help you interpret what's going on the chart and give you a suggestion on what might happen again in the future. I believe that they work best when you combine them for confirmation, that you look at them to show this is what I see on the price action, and this indicator confirms what I see. Doesn't mean you go find the indicator to confirm it. It means you find ones that you like, and if they confirm it, great. So what's important when you're using technical indicators is understand, as I'm saying over and over again, they're calculations on price action. So it's very important for you to understand that you first always have to look at what price action, and you use the indicator to confirm what you're seeing in the price action. Or it may tell you what you're seeing in the price action is wrong. So that's most important. Understand that technical indicators are just another interpretation of price action. So you need to understand the type of day and the time of day before you go ahead and just blindly trade an indicator. Another advantage or another tip for using indicators is using a top-down macro to micro analysis. In other words, start off with your longer term and then zoom into the short term. What we usually say is the longer term and multi-time frame analysis gives us our direction, and the shorter time frame gives us our entry. And finally, do your homework. If you're going to use an indicator, know what it is, know how it's calculated, know why you're using it. So many times I've seen people who just, have arrows and they don't know why, but they're trading the arrows, but they don't know how they're being calculated. They don't know why they're being calculated. So do your homework. If you're going to use the indicator, understand what it's plotting and why it's plotting it so that you can help understand when there might be a false signal or when with the type of day and the time of day that this indicator may not work because you understand how it works. Now, mistakes that people use is that they fall in love with an indicator. Again, the first video is so important. The most important thing is time of day, type of day. You have to understand what type of day it is so that you're using the right indicators and the right chart patterns. News overrides everything. Again, time of day, type of day. And finally, don't use so many indicators that you get yourself into an analysis paralysis. Find one or two that you like and then master that. And so to help you with that, we want to put our indicators in some categories and how you might use them. So when you think about your indicators, there's basically several categories: overbought, oversold, support and resistance, and market sentiment. Just like our chart patterns, there are indicators that can help us identify overbought, oversold. I think Bollinger Bands are good for that. Keltner Bands, those are envelope type indicators. Stochastic is an oscillator, so stochastic, MACD, RSI, all of those are good with helping us identify overbought and oversold conditions. Remember, news overrides everything. If it's a trending day, we can stay overbought or oversold. Support and resistance, whatever type of pivots that you like. Moving averages are great for support and resistance. Key price levels, open, close, overnight high, low, those are all key price levels that the market will react when they come back to them. Market sentiment, the market internals, good old tick, advanced decline, and other volume indicators. They help us gauge the strength of the market, and that again helps us confirm moves. We may be overbought, oversold, but if our internals are strong, we may stay there. We may not be reversing. On consolidation days, our internals can let us know that this is the time that we may see the market reverse. Another way to categorize indicators, I think, is off of volatility and momentum. So this is another way to look at it. Again, gauging the trend. I have moving averages for support and resistance, but moving average crossovers help us confirm trend. Volume, order flow and market profile, are they indicators or are they a different way of looking at the market? I think they're a different way of looking at the market, but you might want to put them in indicators. It's there. Volatility, Bollinger Bands, I had them for overbought, oversold, but they also are very good for letting us know when the market is very volatile and when we may see a pullback because we're reaching the bands, the Keltner Bands. So again, I always like to go back to type of day as the driving force to our trading. So when we're going in our consolidation, we want indicators to help us confirm that consolidation and that we should be we're overbought and we're going to go back. Or when we're in a trending day, a breakout day, there are indicators to help us gauge the strength of the move and let us know that it's okay to trade the breakouts. Remember, all of this, it's all about being a high probability trader. It's all about defining our edge. Get one indicator that you like. Decide if you're going to be a breakout trader or a reversal trader. Define your edge and trade that one edge. You see that I'm repeating some things in each of these videos because I don't want you to get confused and try to do too much. Define your edge, master your edge, and then begin to layer in new things as you become good at it. Because again, your primary job as a trader is to identify opportunities in the market and apply the right strategy. Breakout trades, reversal trades, depending on the type of day. That's what a high probability trader does. They're able to look at the market, identify the playing field, and only trade when the odds are in their favor because they're able to distinguish the types of trades. And more importantly, they know how to sit on the sidelines because it's just not their day. So that is our video on technical indicators. Please join us in our next video when we talk risk management. Stop in the name of money. Thanks, guys, and I'll see you next time.